Buffett once said, "Games are won by players who focus on the playing field and not by those whose eyes are glued to the scoreboard." My name is Adrian Meager, and today I'll be talking to you about asset allocation. What is asset allocation? Well, looking at the main asset classes being local and global equities, fixed income, fixed rate bonds, and floating rate notes, and cash, we know that each of these asset classes will have a different correlation of risk and return, which means each should have different behavior over time. Therefore, asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets to an individual's goals, risk tolerance, and investment horizon. How do you manage asset allocation? There are different methods to manage asset allocation in multi-asset portfolios, with some asset managers preferring a top-down strategy and others a bottom-up approach. To recap one of my previous videos, top-down investing involves looking at the overall economic environment, for example, GDP growth, interest rates, and then breaking down these various components into the finer details of which asset classes to invest into. While bottom-up investing focuses on the attractiveness of assets through thorough analysis of individual stocks and bonds, and then building a portfolio based on the attractiveness of those assets. At Orion Investment Managers, we apply a combination approach incorporating both a top-down and bottom-up asset allocation process. Orion's capital market expectations form the basis of our quarterly asset allocation meetings. This top-down approach examines numerous critical components that we believe drive our overall macro view. For example, we would look at and score our expectations on inflation, interest rates, economic growth, and the South African rand. Once we have completed our capital market assumptions, we then incorporate these into our expected return calculations. These calculations calculate the expected return for both local and global equities, bonds, listed property, and cash, which enables us to make a calculated decision on which asset classes to invest into to try and maximize our clients' risk-adjusted returns. Our bottom-up process is driven by the attractiveness of the individual stocks. So it's possible that Acorn, Palmyra, or Capita Asset Management may purchase a share when the stock market is deemed expensive overall, as we still see value in that equity, as it's offering sufficient margin of safety or attractiveness relative to other securities. We may also find several undervalued stocks in a sector and thus have an overweight position to that sector. This is how we believe we can best utilize the combination of our top-down and bottom-up approaches. Finally, we run a quant-driven efficient frontier screen, focusing on risk-averse return as a sanity and risk check. This provides us with our final asset allocation weights across our various portfolios and funds. Perhaps no single investment principle has more impact on portfolio performance than asset allocation. And while asset allocation does not ensure capital growth or provide guarantees against loss, academic research has shown that asset allocation is responsible for more than 85% of a portfolio's positive performance over time. Asset allocation has such an impact on performance, we continue to review our strategic asset allocation and amend our model portfolios and funds in line with our house view. We will remain true to our investment philosophy, and we will continue to manage our clients' investments accordingly. Thank you, and until next time, goodbye.